Welcome to Zoom Out Bitcoin, the channel where we take a step back, zoom out, and look at the bigger picture involving Bitcoin. I've made videos in the past talking about what Bitcoin is, where I think Bitcoin's going, and how I think it'll get there. But today, I want to talk about who should actually invest in Bitcoin. Investment vehicles are exactly that. They're vehicles to get you from point A to point B in different terrains, over different land masses, in different weather conditions, and importantly, for different people. This is true with Bitcoin as well. You wouldn't pull out a Ferrari if there was muddy terrain, and you wouldn't show up to your local grocery store in a 747. Because of this, it's important to figure out what type of person and under what conditions is Bitcoin right for? Who should be buying this asset? Whenever, anytime you look at investing in an asset, you're not just looking at the performance of that asset. You're also looking at the opportunity cost that you give up from investing in other assets during the same time. My favorite example of this is high-yield savings accounts. Over the last 5 years, we've seen high-yield savings accounts average anywhere from 3 to 4.5%. Over a 5-year time frame, a lot of people felt like this was a solid investment. They were getting 4% per year. During that exact same time, the S&P 500 compounded annually at 15% per year. This means for every $1,000 you let sit in a high-yield savings account since 2020 to today, you could have gained an extra $800 if you had left it in the S&P 500 instead. This is huge. That's why today we're not only going to look at how Bitcoin performs as an asset, what type of investment vehicle Bitcoin is, and what type of people should get into it, but we're also going to compare it to other assets. That way we understand what the opportunity cost and what the rest of your portfolio should really look like. First and foremost, let's talk about the metric that most investors care the most about, and that's returns. Anytime you invest money, you're looking to get money back on what you've put in. Specifically, we're going to look at compound annual growth rate. Compound annual growth rate is the average percent increase compounded annually over the lifetime of the asset. This is extremely important for understanding what the returns could be, especially over a very long period of time and over a very long time horizon. Bitcoin has a high compound annual growth rate, but not just a high one, an extremely high one. Over the last 10 years, Bitcoin's compound annual growth rate is 100%. That means the asset essentially doubled, on average compounded, over the last 10 years. $1,000 in Bitcoin in 2015 would be worth nearly $100,000 today in 2025. Over the last 5 years, Bitcoin has a 65% compound annual growth rate. This isn't as good as doubling every year, obviously, but it's still extraordinarily high. And it does show a larger trend of the compound annual growth rate going down, which I expect to continue over the next 5, 10, and 15 years. But whenever we compare it to other assets, which we're about to do, you'll realize this is still a massive number. So let's get into those other assets. The S&P 500, on the other hand, boasts a 5-year compound annual growth rate of 15%. This is great. This has been exceptional. As most people invest in the stock market over this time period knows, the stock market has done extremely well. The S&P 500's 10-year compound annual growth rate is only slightly lagging behind at 13%, showing that the stock market tends to be a fairly safe investment. Gold, on the other hand, also has a 15% compound annual growth rate over 5 years, but its 10-year time frame shows only a 10% compound annual growth rate, showing that gold specifically has seen most of its returns in the last 5 years, and going back historically has been a lot more stagnant and a lot less likely to give you the type of returns we've seen recently. So what does this actually mean? The following is a chart that compares the performance of Bitcoin, gold, stocks, and long-term treasuries over the last 5 years. You can see a couple of very important things. First and foremost, Bitcoin absolutely warps the chart because of its performance, getting a nearly 10,000% return today, meaning that $1,000 invested in 2020 would be worth $10,000 today. Gold and stocks during the same time period had one of their best runs ever, and is nearly double over 5 years, which is a fantastic investment, and anyone who had their money in it feels very good about that. Fourth is long-term bonds, which actually goes negative on this chart, as we've been in one of the worst bond bear markets we've ever seen, as we began rapidly increasing rates. Looking at this chart actually shows another thing, which will bring us into our next topic. It's obvious that Bitcoin didn't go in a straight line from 0 to 10,000%. It was very bumpy along the way, which is where we begin talking about volatility. Similar to compound annual growth rate, Bitcoin's volatility is high, and not just high. It is very high when compared to other assets. Bitcoin has a 5-year volatility rate of nearly 50%. This is 3 to 4 times that of the S&P 500, which has a 15% volatility rate. And gold over the last 5 years has actually experienced a 20% volatility rate, which is much higher than its historical average, but has mostly been driven by the large upward swings in gold. What a 50% volatility rate means is that in a given year, Bitcoin can fall within plus or minus 50% of its expected yearly outcome. What this actually means for investing is Bitcoin is extremely difficult to rely on. You can't count on the money being there 3 months from now, a year from now, 2 years from now. Only after very long periods of time can you reliably count on some amount of returns greater than other assets. But if you need this money, for instance, if you're living off of steady income in retirement, or you need to make withdrawals to make mortgages or payments or student loan payments, Bitcoin is not reliable enough to consistently do this. It might swing 50% down, and if you need to pull from your portfolio, this isn't a reliable option. So how do we actually analyze this contrast between high growth rate and high volatility? For that, we're going to use a concept called risk-adjusted rate of return. This is essentially trying to calculate how much return are you getting for how much risk you're actually taking on. For this video, we're going to use something called Sharpe ratio, and it's important to note that a higher Sharpe ratio is better. It essentially means you're getting more potential upside for the actual amount of risk that you're taking on. So let's start with what has become the standard for long-term assets, and that is the S&P 500. Over the last 5 years, the S&P 500 has a Sharpe ratio of 0.9. Gold, on the other hand, has a Sharpe ratio of 1.0, meaning gold and stocks are performing very similarly over the last 5 years, which matches with the volatility and the returns that we've seen. Bitcoin, on the other hand, actually has a Sharpe ratio of 1.2. This means that even when adjusting for the volatility, it actually comes out that the amount of explosive growth that Bitcoin experiences outperforms the amount of risk that you're actually taking on. What this means when investing is that even for individuals who are looking to minimize their risk and are looking to actually maximize their returns while keeping that risk as low as possible, Bitcoin is a good option for them. It's been shown that even small allocations of Bitcoin in standard portfolios actually increases the risk-adjusted rate of return of that portfolio. While metrics are obviously extremely important, I also want to talk about some narrative views on these assets. Specifically, I want to talk about the concept of Bitcoin being an inflation hedge and a safe haven asset similar to gold. Let's start by talking about Bitcoin as a hedge against inflation, and specifically we mean global liquidity. That's the amount of liquid money available in the money supply. There are 2 important metrics for actually measuring an asset's ability to be a liquidity hedge or an inflation hedge. These are correlation to money supply and then magnitude of that correlation. Firstly, correlation. This is how likely an asset is to follow what the money supply does. It's worth noting that all of these measurements are taken with some form of lag period to actually allow the asset to have time to adjust. This is typically about 3 months. We'll start with the S&P 500, which has the highest correlation to specifically US money supply at 97%. This means that if the amount of dollars is increasing, then there's a 97% chance that the stock market in the S&P 500 is going to be increasing within the next 3 months. On the flip side, if the amount of US dollars is decreasing, then there's a 97% chance that the US stock market and the S&P 500 will be decreasing over that time frame. Gold and Bitcoin have very similar correlation rates at 85% for both of them. But let's talk about the next metric, which is magnitude. Not just which direction is the asset going to go, but how far in that direction are they going to go. The S&P has the lowest magnitude at 40%. This makes sense whenever you begin thinking about the S&P 500 and many of these companies, as there are a lot of other factors that play very heavily into how the pricing actually comes out. Whereas gold and Bitcoin are a lot more impacted by these liquidity changes. Gold has an 87% magnitude rate, and Bitcoin has the highest magnitude at 92%. This means that if the global money supply increases by 10%, you can expect the price of Bitcoin to increase by 9.2% over a 3-month time frame. It's this high magnitude corresponding with a high correlation rate, at least relative to assets other than the S&P 500, that makes Bitcoin, in my opinion, the best inflation, or more specifically, liquidity hedge that's available on the markets today. It's the fastest horse in this global inflation race. So next, let's talk about actually being a safe haven asset, as gold has globally been considered. Bitcoin tries to frame itself as digital gold, and I believe it's working there, but it's not quite there yet. Whenever you look at operating actually as a safe haven asset, Bitcoin has significantly underperformed its gold counterpart. Specifically, looking at the April 2nd Liberation Day, Bitcoin was down nearly 12% over the following weeks, while gold was up 8% in the exact same time period. This means that right now, Bitcoin is reacting a lot more as a risk-on asset than a safe haven asset that it intends to be, that reacts positively to negative news. I view Bitcoin in this way. It's a once-in-a-decade risk that has a potential once-in-a-lifetime reward. Because of this, the answer to who should buy Bitcoin is almost everybody, and specifically anyone who can afford to take on that risk. The question is really just, how much Bitcoin should they have? I break this down into 4 common groups of investors. And first, young investors with small portfolios. These investors can handle volatility and have very long time horizons to benefit from the extremely high compound annual growth rate that we've seen so far. These are investors that can allocate 10 to 20 or a larger percentage of their portfolio and afford to take on that risk when they're very young and watch their money potentially grow into life-changing returns later. Next is the middle-aged investor, someone with a family who's hoping to retire in the next 5 to 15 years. This individual wants to balance potential growth, but also their primary focus is protecting their family's future and protecting their future retirement. Because of this, it doesn't make sense to have a large allocation to an asset that could have heavy downswings or even go to zero. That being said, having no allocation to Bitcoin in this scenario doesn't make sense. This individual can still benefit from the growth of Bitcoin over the course of their retirement and can benefit greatly from having a potential liquidity hedge in the event that we do continue to print money and see rampant inflation. Because of this, I believe a 5 to 10% allocation for this type of individual makes the most sense. The third group is the old investor, the retiree. This individual has already built their portfolio and they're retired. They're living off of their retirement and they're taking payments at a steady and consistent basis. This individual doesn't need Bitcoin. They don't need the growth. They've already worked their entire life and now they're trying to enjoy the fruits of their labor. An allocation of 5% or less is what makes sense for this individual. There's no reason to risk 10, 15, or 20% of their portfolio unless it's something they truly believe in or if they want to focus on potentially passing on to next generations. Fourth is the corporations and wealth funds. These individuals aren't looking at retirement and they have massive portfolios that they're trying to manage. Specifically, these organizations are trying to maximize one thing, the amount of profits they get for the amount of risk they take on. Because of this, a Bitcoin allocation of 5 to 15% is necessary to actually reach their maximum risk-adjusted rate of return. I want to be clear as I talk about this. All of these allocations come from traditional and conservative portfolio management methodologies. They're designed to maximize your return while minimizing your risk and protecting you from the potential downside of Bitcoin going to zero. But the truth is, I don't follow these allocations personally. I have over half of my investable assets into Bitcoin. Why is this? It's because I've done years of research. I believe in where Bitcoin's going, I've studied what the risks are, and I feel comfortable taking on these risks. If you truly understand an asset, trust its long-term future, and know what risk you're taking on, then at the end of the day, it's your money and it's your life. I believe Stanley Druckenmiller said it best when asked about managing risk. If you really see it, put all your eggs in one basket and watch that basket extremely closely. So whether it's 1% or 100%, just make sure you're doing it for the right reason, that you understand both the upsides and the downs. Thank you all for watching this video. I hope to see you all again soon, and make sure to like, subscribe, and leave a comment if you have any questions. Bye.